Thank you very much for giving me the floor, and I'll try to stay within my 10 allocated minutes, but I can't guarantee, but I'll try. So it's my great pleasure to come before you. This is the fourth and last time this year. And as you will remember, on previous occasions, we have discussed the shifting global environment. We've discussed its implications for the European economy. And that was against the landscape of major technological, geopolitical and structural changes that continue to redefine our economy. So today what I will do is focus my remarks on topics that was of interest to you, which are the instruments in our toolkit. And I know that you have received various production by well-informed professors and representative of the profession. But before I do that, I'm going to comment quickly on the world economic outlook and, more importantly, the euro area outlook as we see it, bearing in mind that in about 2 weeks' time, on the 17th and 18th of December, we will be having a Governing Council meeting which will be deciding our monetary policy stance. And at that point, we will produce new projections which are elaborated both by the ECB and by the national central banks together. So the numbers that I'm going to quote now will most likely be revised as a result of this new projection exercise in 2 weeks' time. I'm sorry that we are not meeting in 2 weeks' time, but I cannot jumpstart and comment on numbers that I'm not totally aware of. So, what happened in the third quarter of this year is that our economy grew by 0.2%, and that was supported by robust domestic demand, and in particular by the service sector, which grew notably as a result of a pickup in digital services. So tourism is still an active driver of the service activity, but the pickup in IT infrastructure, investment in artificial intelligence by many operators into their functioning and their operations was a driver of this growth. By contrast, manufacturing and exports were held back by higher tariffs, still heightened uncertainty, and a stronger euro as well. You must have received this document, which is a recto verso document. On the recto, you have a good chart that indicates what economic activity we have benefited from and how growth has evolved over the course of the last few quarters. We are, as I said, expecting the next numbers in reasonably short order. So looking ahead, a growth in economic activity should benefit from increased household spending and a resilient and more inclusive labour market with the highest labour force participation rate since the start of the euro. Again, on this chart, you have an interesting box on the labour market, on the unemployment and the job vacancy rate, and you see that it is the vibrancy of that market is gradually abating, but we are still on a positive trend. In addition to that vibrant labour market, or rather inclusive, substantial infrastructure and defence spending are also expected to support the economic activity. The global environment is likely to remain a headwind, and the impact of higher tariffs on euro area exports and manufacturing investment continue to unfold. Risks to the outlook has become more balanced thanks to the EU-US trade deal reached over the summer, thanks to the ceasefire in the Middle East and progress in the US-China trade negotiations. That's on the upside. At the same time, the outlook remains uncertain, owing to a still volatile global trade environment, a potential deterioration in financial market sentiment, and geopolitical tensions that remain. Turning to inflation, it remains close to our 2% medium-term target. Again, on the chart, you have a good chart on inflation and its components. According to Eurostat's flash estimate, inflation edged up slightly to 2.2% in November, so it was 2.1% in October, 2% in September, 2.2% in November, and that is mainly due to higher services and energy inflation. Core inflation, excluding food and energy, was constant at 2.4%, and our indicators of underlying inflation remain consistent with our 2% medium-term target. The reduction in inflation towards our medium-term target has been supported by a gradual moderation in wage growth from its peak at 5.7% in the second quarter of 2023 to 3.9% in the same quarter of this year. And of course, it will be seen at our next projection exercise what kind of indicators we are receiving and how wages are expected to evolve. We expect inflation to stay around our 2% target in the coming months. Risk to the outlook continue to be two-sided, although more narrow than they were. Uncertainty remains higher than usual pre-COVID, owing to volatile global trade policies, but has clearly abated since the conclusion of the agreement between the US and Europe in relation to tariff. The next Eurosystem staff projection, to be published on the 18th of December, will shed further light on both growth and inflation. As our assessment of the inflation outlook was broadly unchanged, as a result, at our last October monetary policy meeting, we kept our interest rate unchanged. We continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance, and in particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, as well as the dynamics of underlying inflation and the strength of monetary policy transmission, and we are not committing to any predetermined path. So let me now turn to the ECB's instruments that were the topic of interest on the occasion of this meeting. We have reconfirmed in our recent strategy assessment that we are committed to setting monetary policy such that inflation stabilizes at our 2% target in the medium term. That has not changed. We had it in our strategy review of 2021. We maintained it unchanged, and we think that it has served us well so far. Our primary monetary policy instrument is the set of three key ECB interest rates. The DFR is the best known, but there are two other ones that apply in certain circumstances, for refinancing in particular. But we may also use other instruments than interest rates, as appropriate. And we would do that to preserve the smooth functioning of monetary policy transmission and provide additional accommodation when interest rates approach their lower bound, which is not the case at the moment. Effective transmission of our monetary policy stance across the euro area is critical for delivering on our price stability mandate. We must therefore remain attentive to situations in which cross-country differences in the impact of our policy on key economic variables become excessive or signal that the transmission mechanism is impaired. And to address such concerns, we have developed over the course of the years several tools to safeguard the smooth transmission of our monetary policy. And I will focus on three specific instruments which have been commented upon by the reports that you have commissioned. The outright monetary transactions, which is called OMTs. That was announced in August and September of 2012, and that was right in the midst of the Greek crisis, and then when there was suspicion that the euro area would not hold. The second that I will comment is the transmission protection instrument, the TPI, which we developed and announced in July 2022, and then the Pandemic Emergency Purchase Programme, which is the PEPP, announced in March 2020. I could have included in that the TLTRO, which is also an instrument that we have used at the time of COVID and the pandemic in order to stabilize the economy and facilitate and encourage the financing of economic activity. But I'm focusing on these three. So the first one, the outright monetary transactions, 2012, which was a follow-up to Whatever It Takes. This OMT is designed to safeguard the transmission of monetary policy in all euro area countries. OMTs enable us to address severe distortions in government bond markets, which originate from, in particular, unfounded fears among investors of the reversibility of the euro. You might remember some speeches about the fact that the euro is irreversible. My predecessor pronounced that word several times, and associated with that was the OMT, which was, by the way, never ever used. A necessary condition for OMTs is strict and effective conditionalities attached to an appropriate European Stability Mechanism programme. So it's not an IMF programme, it's an ESM programme, which includes conditionality that address some of the weaknesses of the fundamentals of that economy. That's for the OMT. The Transmission Protection Instrument, the TPI, can be activated to counter, and all words matter here, unwarranted, disorderly dynamics in the market for securities issued in countries experiencing a deterioration in financing conditions that are not warranted by country-specific fundamentals. In that situation, the Governing Council will consider a cumulative list of criteria to assess whether the countries in which the Eurosystem may conduct purchases under TPI are pursuing sound and sustainable fiscal and macroeconomic policies. The criteria, among others, include compliance with the EU's fiscal framework and an absence of severe macroeconomic imbalances. Final one is the Pandemic Emergency Purchase Programme, which was launched and used, by the way. TPI was not used either. OMT, TPI available in the toolbox, ready to go, never used. The Pandemic Emergency Purchase Programme was launched and used in response to the COVID-19 shock, which affected all euro area countries, but to different degrees. The programme was designed with a dual role. On the one hand, it supported market functioning, as well as, second role, the transmission of monetary policy. On the other hand, it enabled a substantial easing of the monetary policy stance to counter the serious downside risks to price stability posed by the pandemic. So, transmission and stance, both of them combined in one single instrument. In the face of the extraordinary economic and financial shock, the programme's flexibility, which allowed the pace and composition of purchases to be adjusted, really important, proved critical in stabilising markets, addressing impediments to transmission, supporting the economic recovery and safeguarding price stability. Again, the 2 pages provide you with a reference to how much was actually used for the PEPP. So the size and pace of PEPP were recalibrated and reinvestment of maturing bond were fully discontinued at the end of December 2024, contributing to the normalisation of our balance sheet that you have alluded to. So together, these tools demonstrate that the ECB's toolkit is adaptable to unprecedented challenges while remaining clearly within the scope of monetary policy competence. And consistent with our commitment to transparency and accountability, we have engaged extensively with your committee to explain our assessment and answer questions on these tools. The ongoing dialogue underscores our dedication to ensuring that our actions are thoroughly scrutinised and clearly understood by the public. If you look at our website, for instance, you have all the terms and conditions, criteria and assessments that take place in order to activate any of these instruments. So to conclude, as also highlighted in our monetary policy strategy statement, the Governing Council will continue to respond flexibly to new challenges as they arise. It is essential that not only monetary policy, but other policies take the lead in strengthening Europe's prospects and reducing vulnerability to future shocks. This means creating the right conditions for Europe's sources of economic strength to reach their full potential, most notably by making the single market truly single. And in that context, I warmly welcome the European Commission's forthcoming package on capital market integration and supervision. These proposals are, in our view, key to overcome fragmentation, enhance the efficiency of capital market and foster innovation. We have solutions at hand, some of them in our hands. I've just described some of them, but other solutions necessary are in the hands of others. Thank you very much.